As businesses slowly start to recover from the coronavirus pandemic, the stock market is rapidly recovering. First Financial's Chris Hagedorn talked about that surge with Courier Market Engagement Director Kelly Snyder.
Thanks, Kyla. Well, Chris, thanks for being here again. I know we talked a few weeks ago, and just a couple things have changed, right? So a couple questions. First of all, what's drawn your attention as an investor in the current backdrop?
Yeah, so what we've written about most recently is what we're calling minding the gap. And no, we're not talking about the London Underground here, but as you can see in the chart, we're really referencing a widening negative earnings growth gap that's opened up for the balance of 2020. So you can see that in the yellow bars pointed downward. You know, that's obviously been a consequence of COVID and a shutdown of economies worldwide. And I think it's also created a tremendous amount of downside volatility for markets in February and March. What's interesting is investors haven't seemed to mind nearly as much in April and May, with the S&P 500 recovering about 3/4 of those losses. And, you know, this is coming at a time when the fundamentals candidly have been pretty awful up until more recently, where we've just started to see some early signs of improvement there.
So if the fundamentals are so bad, why has the market rallied over the past couple of months?
Yeah, so that's a great question. I think a question on a lot of people's minds. And what we would say is really until most recently, it's been less about the fundamentals and more about what we would call liquidity and sentiment factors. So, you know, what are those? Well, liquidity is effectively the ease with which a company can do business without being under duress. And I think the policy response we got out of both Washington and the Fed has created a tremendous positive liquidity backdrop. And then sentiment is how investors feel about certain securities. It's often reflected in what they're willing to pay for them. So what we're showing in this chart are two measures that we track in each one of those three categories. So just by way of explanation, you know, the average percentile reading is how a metric scores on a range of 0 to 100 relative to history. So a low percentile reading would be, you know, well below average and vice versa. And then the momentum reading is the percentage of metrics that have shown improvement over the prior month. So the point we're trying to make here is if you look at the bars on the fundamental side, you know, they're much lower than the bars on the liquidity and sentiment side. Now, the caveat here is when we've started to see signs of the fundamentals begin to catch up. And it's not to say that the fundamentals are great by any stretch, but they're getting less bad, so to speak. So I think beyond that initial relative improvement that we're seeing now, I think the question will come back to, you know, what's the ultimate shape of the recovery look like in terms of how fast can we get back to normal?
So what does this mean for investor portfolios?
Yeah, so what should we be doing right now? And I think what I'm going to say is probably going to sound unsatisfying to some, but it's truly how we feel right now. And that is, frankly, we don't think it's time to be uber bullish or bearish, given how uncertain the backdrop is and how there could be a number of different scenarios that could be yet to play out. What I mean by that is, if we do in fact get a quick V-shaped recovery and things get back to normal quickly, then the improvement in the sentiment measures I was talking about earlier will be correct in anticipating an eventual improvement in the fundamentals. If, on the other hand, we get a second wave of the illness, if the recovery is more prolonged and drawn out than expected, or if political risks begin to ramp up, then one could certainly argue for the opposite. So point here is we think it's a time to almost overemphasize diversification. And as a result of that, we've got a lot of underlying hedges within the portfolio. So as you look at the table here, point is there are pockets of our positioning that are leaning more aggressive. There are pockets of our positioning that are leaning a bit more defensive. And that's deliberate in really trying to maintain that broad diversification.
Well, that makes sense. Well, again, Chris, thanks for being on. We look forward to hearing how things are going in the next couple of weeks. So again, we appreciate your being on. So.